Hey now, we're going to cover Metromile. It's one of many stocks that just got annihilated by the SPAC bubble burst in late February of this year and has since fallen like 80% from its all-time high of $20. On top of that, the company has been hammered by the pandemic as people aren't driving much these days. So while it's trading around the $3 range, I'm very bullish about Metromile as a disruptor in the auto insurance industry, and I genuinely feel it's positioned well in its early stages of growth ascension to make some serious noise in an industry that's outdated and, quite frankly, ripe for disruption. Metromile is a cutting-edge company that provides pay-for-usage car insurance. In other words, you pay for the miles you drive. They have the best rates because they can correlate your premium with how much you drive, thus offering affordable pricing for everyone and saving customers on average like 47% on their car insurance. Who wouldn't want that? So essentially you save money by driving less. Mind you, existing insurance models from the likes of Geico, State Farm, etc., those are based on stupid variables like your neighborhood, zip code. They're just antiquated insurance pricing models that don't make sense anymore. Metromile offers various policies so people can find something specifically suited to their needs. A real-time, customized approach to auto insurance that simply hasn't existed to date. Something that will also be equitable to each customer's individual situation. The company has also cited an average customer retention of 3.5 years, which isn't common because, believe it or not, customers aren't loyal as you think to their car insurance. Metromile has a very long runway for growth ahead of itself and expects to end the year with about $70 million in revenue. The U.S. car industry alone accounts for like $250 billion annually. Even at 1%, that would allow a potential revenue of like $2.5 billion in the U.S. alone. Globally, it becomes even higher. Metromile operates in a very large market, but it's not dominated by one company. In fact, of all the U.S. carriers, no one company has more than 20% market share. And Metromile currently operates in 7 states, but has ambitions of expanding to all 50 in like 6 months, or by early 2022. In other words, 45 million drivers can save with Metromile today, but around 143 million by 2022, representing about $160 billion of potential premiums. Another growth engine for the company will be the ability to bundle insurance products and services to provide even larger savings. They're partnering with Hippo and other lead sources show me that they're serious about growing these cross-selling opportunities. One of the more intriguing growth engines for me personally is the enterprise business. This software as a service product that is offered to other insurance companies could be a billion-dollar company in itself. Metromile will be able to license its risk model to insurance companies and help them with claims experience, improve operating margins, and decrease fraud, all while making money per policy. As for valuation, this company has the potential to grow top-line revenues at least 20%. If this happens, margins should expand, and when that happens, the fun starts. It will start getting picked up by mainstream and quantitative-driven investors, and multiples will start expanding. This is still an early-stage company despite starting 11 years ago and growing revenues over $100 million per year. As the company begins to roll out their products throughout the U.S. and scale, the revenues could grow significantly in years to come. The price to sales and price to book figures are incredibly low for a company in its early stage of its growth trajectory, which to me shows how little the market is pricing its continued growth of the company. Even at the conservative revenue rate of like 20%, shares should be trading closer to at least like 20 on the price to sales, which would give it a price target around $20. Based on cash on hand, which is like $200 some million, I feel it's sufficiently funded to continue its expansion well into 2022 and beyond, even in the current operational environment. The biggest risk would be continued recessionary pressures caused by the pandemic and people driving less in the coming years, which I highly doubt. Metromile was founded in 2011 by tech entrepreneur and Silicon Valley OG David Freeberg, who continues as their chairman today. He was like a Google guru and started the Climate Corporation, which I think sold for like $1 billion. The guy has a proven track record. He also brought on Dan Preston, who was the former CTO of Uber. He's now the CEO. Needless to say, they've got a lot of horsepower on the management side, and they've got great backers, including Chamath and Mark Cuban. The pandemic has actually been a headwind to Metromile's growth objectives, as its insurance prices are based on per-mile rates. Reduced driving means less money for each policy sold. As driving picks up, we expect to see these numbers to improve for Metromile. Therein lies the opportunity short-term before the long-term growth trajectory takes hold. We may not get another chance at these depressed levels. I expect Metromile to be a force that is constantly innovating and making better insurance products for consumers. A better, more customized insurance product is needed more than ever, especially in the next era of autonomous and semi-autonomous driving.